Before we begin, a critical disclaimer. I am not a financial advisor, and this video is for educational and informational purposes only. The content presented here should not be taken as financial, investment, legal, or tax advice. Trading cryptocurrencies, especially day trading, involves a very high degree of risk and is not suitable for all investors. You can lose all of your invested capital. Please do your own research and consult with a qualified professional before making any financial decisions. Your financial situation is unique, and any decisions you make are your sole responsibility. You grab your phone. You open the app. Bitcoin is pumping. That little green number is climbing, and you feel it, that electric jolt of FOMO, the fear of missing out. You think, this is it, it's going to the moon. You check again an hour later while you're in line for coffee, and your stomach plummets. That beautiful green number is now a blood-red arrow pointing straight down. The market giveth, and the market taketh away. We've all been there. That feeling of helplessness, of being a passenger on a roller coaster you can't control. But what if you could flip that script? What if, instead of being a victim of those wild gut-wrenching swings, you could profit from them? What if you could learn to harness that chaos, to see that volatility not as a threat, but as an opportunity? That, in a nutshell, is the promise of crypto day trading. Now I know what you're thinking. Day trading. The words alone sound intimidating. It sounds like something for Wall Street wizards in $1,000 suits, staring at a wall of 20 monitors, screaming buy and sell into a phone. It sounds complicated, risky, and completely out of reach for the average person. I'm here to tell you that's not the full story. For the next few minutes and over this entire series, we are going to pull back the curtain. We're going to break down crypto day trading into plain, simple English. No confusing jargon. No get-rich-quick fantasy. My goal is to give you a rock-solid foundational understanding of what this world is really about, how it actually works, who it's for, and who it's absolutely not for. By the end of this journey, you will be able to make an informed decision about whether this is a path you even want to explore. We're not selling a dream. We're building a framework of knowledge. So let's start with the absolute basics. Why does day trading even exist in the crypto market? The answer is one word: volatility. Imagine the stock market is like a giant, slow-moving river. It has currents, it moves, but generally it flows in a predictable direction over a long period of time. You can put a boat in it, say an S&P 500 index fund, and trust that over 10 or 20 years it'll likely carry you further downstream. Now imagine the crypto market. It's not a river. It's the open ocean in the middle of a hurricane. One minute you have 10-foot waves crashing over the deck. The next minute it's eerily calm, and then a rogue wave comes out of nowhere. It's chaotic, unpredictable, and frankly, terrifying for a traditional boat. Most people in crypto are told to adopt the HODL strategy. HODL just means hold on for dear life. You buy a coin like Bitcoin or Ethereum, you put it in a digital wallet, and you try your best not to look at it for 5 years. You're essentially building a very strong boat, hoping that after the storm passes, you'll find yourself in a beautiful new land of riches. You are a long-term investor. You believe in the fundamental technology and its future value. You are betting on where the market will be in the distant future. A day trader is not a boat captain. A day trader is a professional surfer. The surfer doesn't care where the ocean will be in 5 years. They don't care about the final destination. They care about the waves. They paddle out into that chaos and they look for a wave, a price swing. They ride that wave for a short, intense period, and then they hop off before it crashes, ready to catch the next one. They might ride a wave going up, or even a wave going down, a concept we'll explore later called shorting. The point is, they aren't trying to cross the ocean. They are profiting from the moment-to-moment energy of the water itself. So the fundamental goal of a crypto day trader is simple: buy low, sell high. But here's the crucial difference. They aim to do it multiple times within a single day. We're not talking about buying Bitcoin at $20,000 and selling it at $60,000 3 years later. We're talking about buying it at $20,000 and selling it at $20,150 10 minutes later. The profits on each individual trade are often tiny, a fraction of a percent, a few dollars here, a few dollars there. It sounds insignificant, but the strategy is based on repetition. You make a small profit, you get out, you find the next opportunity, and you do it again, and again, and again. It's about accumulating a large number of small wins that add up to a significant gain by the end of the day. Let's use an analogy that has nothing to do with finance. Imagine you're a fruit stand vendor. A long-term investor is like a farmer who buys a plot of land, plants an apple orchard, and waits 5 years for the trees to mature so they can harvest the apples. It's a long, patient process, betting on the future growth of the orchard. A day trader is not the farmer. The day trader is the guy who goes to the wholesale market at 5 a.m. and buys a crate of apples for $1 per apple. He then takes that crate to a busy street corner at lunchtime and sells each apple for $1.25. He's not growing anything. He's not waiting years. He's taking advantage of a small price difference in a short period of time. He makes a 25-cent profit on each apple. It's not much, but if he sells 1,000 apples by the end of the day, he's made $250. Then he wakes up the next morning and does it all over again. That is the essence of day trading. You are the digital fruit stand vendor. You're not concerned with whether the Apple company will invent a new super apple in 10 years. You are only concerned with the price of apples between 5 a.m. and 5 p.m. today. You are looking for small, temporary imbalances in supply and demand and capitalizing on them quickly. This is why volatility is the day trader's best friend. In a calm, flat market where the price of Bitcoin barely moves all day, our surfer has no waves to ride, and our fruit stand vendor finds the price is the same at every market. There's no opportunity. But in a volatile crypto market, where prices can swing 5 or 10% in a single day, there are waves everywhere. There are hundreds of small opportunities to buy low and sell a little bit higher, if you know where and when to look. Now, I can feel the next question brewing in your mind. It's the big one. If it's just about buying low and selling high, and the market is so volatile, why isn't everyone doing this and getting rich? Because it is incredibly difficult. And this is where we have to be brutally honest. While the concept is simple, the execution is a masterclass in psychology, discipline, and strategy. That surfer makes riding a 20-foot wave look easy, but we don't see the thousands of hours of practice, the hundreds of wipeouts, the broken bones, and the deep understanding of ocean dynamics that made it possible. The vast majority of people who attempt day trading fail. They lose money. Why? Because they treat it like a casino. They gamble. They ride the emotional waves of FOMO and fear, buying at the peak of the hype and panic selling at the bottom of the crash. They act like the person checking their phone in line for coffee. A successful day trader does the exact opposite. They operate not on emotion but on a cold, hard, data-driven strategy. They have a strict set of rules for when to enter a trade, how much to risk, and most importantly, when to exit, whether it's for a small profit or a small controlled loss. They aim to be the casino, not the gambler. They play a game of statistics and probabilities, knowing they won't win every trade, but by managing their risk, their wins will ultimately be bigger than their losses over time. So how do they do that? How do they know when a wave is coming? How do they read the ocean? It's not about a gut feeling or a hot tip from some guy on the internet. It comes down to one primary skill: reading charts. Those intimidating charts with the green and red candles, the squiggly lines, and the weird acronyms. That is the language of the market. It's a visual representation of the battle between buyers and sellers. And learning to read that language is the single most important skill a trader can develop. It's how you identify patterns, spot potential opportunities, and make informed decisions based on data, not on hype. It's how the surfer knows which wave is worth paddling for and which one is a dud. Learning to read these charts is what separates the amateur gambler from the professional trader. It's the foundation upon which everything else is built. And that is exactly where we are heading next. So let's talk about these charts. When you first pull one up, it looks like a chaotic mess of red and green bars, like an EKG for a robot having a panic attack. But it's not chaos. It's a story. Every single bar, every peak, every valley is telling you a piece of a story about a battle. A battle between two forces, buyers and sellers. Think of it like this: buyers, we call them the bulls, are always trying to push the price up. They're optimistic. They think the price is going to the moon. Sellers, we call them the bears, are always trying to push the price down. They're pessimistic, or they're just taking profits. Every moment of every day, these two armies are at war over the price of an asset, and the chart is our real-time battlefield map. The most fundamental piece of this map is the candlestick. That's the official name for those little red and green bars. And understanding a candlestick is like learning the first letter of the trading alphabet. Each candle represents a specific period of time. Could be 1 minute, 5 minutes, 1 hour, 1 day, you choose the time frame. For a day trader, we're often living in those shorter time frames like the 1 minute or 5 minute charts. Now let's dissect one. A candle has two main parts: the thick part, called the body, and the thin lines sticking out of the top and bottom, called the wicks or shadows. The body tells you where the price opened and where it closed during that specific time period. If the candle is green, it means the price closed higher than it opened. The bulls won that round. The bottom of the green body is the opening price, and the top is the closing price. If the candle is red, it means the price closed lower than it opened. The bears won that round. For a red candle, it's reversed. The top of the body is the opening price, and the bottom is the closing price. Simple enough, right? Green means price went up in that minute, red means it went down. But the real drama, the juicy part of the story, is in the wicks. The wicks show you the highest and lowest prices that were reached during that time period, before the candle closed. Imagine a single 5-minute candle. Let's say it's a green one. The price opens at the bottom of the body. In those 5 minutes, a huge battle happens. The sellers, the bears, might have pushed the price way down for a moment. That lowest point they reached creates the bottom wick. But then the buyers, the bulls, roared back with incredible force. They not only pushed the price all the way back up past the opening price, but they pushed it even higher to a peak. That peak creates the top wick. Then, as the 5-minute period ended, the price settled just a little bit, closing at the top of the green body. That one little candle just told you a whole story. It told you the bears tried to take control, but the bulls came back with overwhelming strength and won the battle decisively. A long wick at the bottom of a green candle is a story of rejection. The market rejected those lower prices. Conversely, a red candle with a long wick on top tells you the opposite story. The bulls tried to push the price to the moon, but the bears slammed it back down. The market rejected those higher prices. Once you understand that every single candle is a mini story of a bull versus bear battle, the chart starts to transform from a random mess into a running commentary of market psychology. Now let's zoom out. You can look at these candles on different time frames. The 1-day chart shows you one candle for each day. The 1-hour chart shows you a candle for each hour. The 5-minute chart shows a candle for every 5 minutes. Why does this matter? Because context is everything. Day trading on the 5-minute chart without ever looking at the daily chart is like trying to navigate the streets of Los Angeles using only a map of a single neighborhood. You have no idea if you're heading towards the ocean or a mountain. The higher time frames, like the daily and 4-hour charts, show you the major trend. Is the overall market moving up, down, or sideways? That's the main current of the river. As a day trader, you're trying to catch the smaller waves on the 1-minute or 5-minute chart, but you want to be paddling in the same direction as the main current. It's much easier to trade with the trend than against it. So, we have our candlesticks, which are the letters. We have our time frames, which are like the paragraphs and chapters. Now we need to understand the landscape, the terrain of the battlefield. This brings us to the single most important concept in technical analysis: support and resistance. Imagine you're in a room with a bouncy ball. The floor is support. The ceiling is resistance. When you drop the ball, it bounces off the floor. The floor supports it and prevents it from going lower. In trading, a support level is a price point where an asset has trouble falling below. It's a price where a ton of buyers, the bulls, tend to step in and say, "Nope, this price is a bargain," and they start buying, pushing the price back up. It's a floor. Now, if you throw that ball up, it hits the ceiling. The ceiling provides resistance and stops it from going higher. A resistance level is a price point where an asset has trouble breaking above. It's a price where the sellers, the bears, tend to emerge and say, "This is getting too expensive," and they start selling, pushing the price back down. It's a ceiling. How do you find these levels on a chart? You just look for them. You look for areas in the past where the price repeatedly bounced off a floor or got rejected by a ceiling. You can literally draw horizontal lines on your chart to mark these areas. Now here's the magic part. What happens if you throw that bouncy ball so hard that it smashes through the ceiling? Suddenly, you're on the next floor up. And what was once your ceiling is now your new floor. This is a core principle of trading. When a resistance level is broken, it often becomes the new support level. And when a support level is broken, it often becomes the new resistance. The battlefield changes. The old ceiling becomes the new floor, and the fight moves to a higher level. As a day trader, these breakout moments, when a price smashes through a key level, are where some of the most explosive and profitable opportunities live. So now we have 3 key elements. The candlesticks telling us the moment-by-moment story, the time frames giving us the big picture, and support and resistance giving us the map of the battlefield. But there's one more crucial piece of intelligence we need. It's one thing to see the price move, to see it break through a ceiling. But how do we know if it's a real move or just a fake out? The answer is volume. At the bottom of most crypto charts, you'll see another set of vertical bars. That's the volume indicator. Each bar shows you how much of that crypto was bought and sold during that candle's time period. Volume is the fuel. Volume is conviction. Volume is the roar of the crowd. A price move that happens on high volume is significant. It means a lot of traders, a lot of money, a lot of conviction is behind that move. If you see the price smash through a key resistance level, and at the same time you see a massive spike in the volume bars below, that's confirmation. That's the market shouting that this is a real breakout. The crowd is roaring its approval. But if you see the price meekly poke its head above a resistance level on tiny, pathetic-looking volume, that's suspicious. It's like a quarterback throwing a touchdown pass in a completely silent stadium. Something feels wrong. It suggests a lack of participation, a lack of conviction. These low-volume breakouts are often fake-outs that get quickly slammed back down. So you have to watch all three things together. It's a symphony. You're watching the story of the individual candles. Are the bulls or bears in control? You're watching where this is happening on the map. Is the price approaching a major floor or ceiling? And you're listening for the roar of the crowd. Is there high volume confirming the move? When you see a long wicked green candle form right on a major support level with a huge spike in volume, you're not just looking at a chart anymore. You're reading a story that says the bulls have made a powerful stand at a critical defensive line, and they may be about to launch a counterattack. We've learned the alphabet, the candlesticks, the floors, the ceilings, and the volume that gives them meaning. But knowing the alphabet isn't the same as writing a best-selling novel. Next, we're going to learn how to form words and sentences, the basic, repeatable chart patterns that traders use to predict what's most likely to happen next, and signal when it's time to strike. These patterns aren't magic spells or ancient prophecies etched into the charts. They are simply pictures of human psychology. A chart is a visual story of a battle, a constant tug-of-war between two armies, the buyers who want the price to go up, and the sellers who want the price to go down. The patterns are the recurring battle formations that appear over and over again, because human beings, especially in groups, tend to react to fear and greed in very predictable ways. By learning to spot these formations, you're not predicting the future. You're making an educated guess based on the emotional state of the market. You're reading the room. Let's start with the most dramatic patterns, the ones that signal a major plot twist in the story. These are called reversal patterns. They suggest that the current trend, whether it's up or down, is running out of steam and is likely about to flip. The undisputed king of all reversal patterns is the head and shoulders. Imagine a mountain climber. They make a strong push up, creating the first smaller peak. That's the left shoulder. Then they gather all their energy for the final ascent, pushing to the highest point of the entire climb. That's the head. But at the peak, they're exhausted. They try one more time to push higher, but they can't match their previous effort, creating a second smaller peak. That's the right shoulder. After that final failed attempt, they're spent. The only way to go is down. In trading, this pattern signals that the buyers are losing control. They had the strength to make a new high, the head, but their follow-up attempt, the right shoulder, was weak. It's a giant flashing warning sign that the uptrend is dying. The critical part of this pattern is the neckline, which is a straight line drawn connecting the low points of the two troughs between the shoulders and the head. When the price breaks below that neckline, it's like our tired mountain climber slipping past their last base camp. The fall is confirmed, and sellers rush in to take control. Naturally, this pattern has an upside-down twin called the inverse head and shoulders. It's the exact same story, but in reverse. It happens at the bottom of a downtrend and looks like a clumsy drawing of a person hanging upside down. It signals that sellers are exhausted and buyers are starting to take over. A break above the neckline here suggests a new uptrend is beginning. Another powerful and much simpler reversal pattern is the double top or double bottom. Think of the double top as someone trying to punch through a ceiling. They jump up and hit their head once. Ouch. They shake it off, take a running start, and jump again, hitting the exact same spot. After failing twice to break through that price level, they give up. The momentum is gone. The price then falls, often sharply. This pattern looks like the letter M, and it's a clear sign of strong resistance that buyers just can't beat. The double bottom is its optimistic counterpart, looking like the letter W. It's like dropping a super bouncy ball on a concrete floor. It hits the floor once, bounces up, falls back down to hit the same spot again, and then the second bounce is so powerful it launches into a new upward trajectory. This shows a strong level of support, a price floor that sellers can't seem to break. When the price moves up past the middle peak of the W, it signals that buyers are now firmly in control. These reversal patterns are the big, dramatic turning points. But not every part of the story is a plot twist. Sometimes the market just needs to take a breath. That's where continuation patterns come in. These patterns suggest that the market is just pausing for a moment before continuing in the same direction it was already heading. The most common continuation pattern is the flag. You have bull flags and bear flags. Imagine a flagpole. A bull flag happens after a very sharp, strong move up. This is the flagpole. After this explosive move, the price consolidates. It drifts sideways or slightly down for a bit. This sideways movement forms a small rectangular or parallelogram shape that looks like a flag hanging off the pole. This isn't a sign of weakness. It's a sign of strength. It's the market digesting the big move, letting new buyers in, and gathering energy for the next leg up. When the price breaks out of the top of that flag pattern, the trend usually resumes with similar force. A bear flag is the exact opposite. It occurs after a sharp, terrifying drop, the flagpole. The price then consolidates, drifting sideways or slightly up the flag. This is the sucker's rally, where some hopeful buyers jump in, thinking the worst is over. But it's just the sellers catching their breath before pushing the price down again. When the price breaks below the bottom of the flag, the downtrend continues. Finally, let's talk about patterns that show a period of indecision, where the battle between buyers and sellers is coming to a boiling point. These are the triangles. There are three main types. First, the ascending triangle. This is a bullish pattern. It looks like a right-angled triangle, where the bottom line is sloping upwards, but the top line is flat. This tells a very specific story. There is a wall of sellers at a specific price, the flat top line. But the buyers are getting more and more aggressive. Each time the price dips, the buyers step in sooner, creating higher and higher lows, the ascending bottom line. It's like someone repeatedly pushing against a door. Eventually, the door is likely to burst open. When the price breaks out above that flat top line, it often leads to a strong upward move. Second is the descending triangle, the bearish twin. Here, the top line is sloping downwards while the bottom line is flat. This means there's a floor of buyers at a specific price, the flat bottom line, but the sellers are getting more aggressive. They are pushing the price down with more force on each attempt, creating lower and lower highs. It's like repeatedly dropping a heavy weight on a wooden plank. Each impact weakens it and eventually it's going to snap. A break below that flat support level usually signals a sharp move down. The last one is the symmetrical triangle. Here, both the top line and the bottom line are converging toward each other. The highs are getting lower and the lows are getting higher. The market is coiling like a spring. This pattern is neutral. It doesn't lean bullish or bearish on its own. It just signals that a big move is coming. The price is being squeezed into an increasingly tight range, and eventually it has to break out one way or the other. Traders will typically wait for a confirmed break above the top line or below the bottom line before making a move. Now, here is the most important thing I will say in this entire section. You must burn this into your brain. These patterns are not foolproof. They are about probabilities, not certainties. A perfect head and shoulders pattern can form, and instead of breaking down, the price can suddenly rocket upwards. A textbook bull flag can form and then completely fall apart. Trading is a game of managing risk and playing the odds. These patterns are just a way of helping you identify when the odds might be in your favor. They are clues in a detective story, not a signed confession from the market. Never ever bet the farm on a single pattern. We've now learned the alphabet with candlesticks, and we've started forming words and sentences with these basic chart patterns. We can read the story of the battle between buyers and sellers. But how do we know how much conviction is behind these moves? How do we know if a breakout from a triangle is a real powerful move backed by an army, or if it's just a fake-out caused by a few rogue traders? We need to measure the volume of the conversation. We need to know if the market is whispering, or if it is screaming. And that's our next piece of the puzzle. Volume is the single most important supporting character in the story of the market. If price is the main protagonist telling us what is happening, volume is the narrator, telling us the significance of those events. It's the context. It's the emotional weight. It tells us if a price move is a genuine, powerful shift in sentiment backed by millions of participants, or if it's just meaningless noise. So what is it exactly? On your trading chart, you'll see the price action up top with all the jagged lines and bars. And down below, you'll see a separate set of vertical bars, usually red and green. That's the volume indicator. Each one of those bars corresponds to the time period of the price bars above it. If you're looking at a 5-minute chart, each volume bar shows you the total amount of that specific crypto that was bought and sold during that 5-minute window. And here's a critical distinction that trips up so many beginners. Volume is not measured in dollars. It's measured in the actual coin itself. So if a volume bar for Bitcoin shows 1,000, it doesn't mean $1,000 worth of Bitcoin was traded. It means 1,000 actual Bitcoins changed hands during that period. At $60,000 a coin, that's $60 million in activity. It's a measure of the raw quantity of the asset being moved. Think of it like this. Imagine you're at a massive stadium watching a football game. The price on the chart is the scoreboard. Tells you which team is winning. But the volume? That's the sound of the crowd. When your team scores a touchdown, and the price of your team's points goes up, you expect the crowd to erupt, right? A deafening roar. That's a price increase on massive volume. The scoreboard change is confirmed by the roar of the crowd. It's legitimate. It's powerful. Everyone in that stadium is participating in that moment. Now imagine your team scores a touchdown, but the stadium is silent. Just a few people politely clapping. The scoreboard changes, the price goes up, but there's no roar. Feels wrong. Unsettling. You'd immediately think something is fishy. Is the scoreboard broken? Was there a penalty flag? This is a price increase on low volume. The move is not confirmed by the crowd. It's weak, suspicious, and you probably shouldn't trust it. This is the first and most fundamental rule of using volume. Volume confirms the trend. When a cryptocurrency is in a strong, healthy uptrend, we want to see volume increase as the price goes up, and decrease when the price pulls back. This shows enthusiasm. The crowd roars when the price pushes to new highs, and they get quiet and take a breath during the small dips. This tells us the buyers are in control, they're aggressive, and they're committed. Conversely, in a strong downtrend, we want to see volume surge as the price falls. This is the sound of panic. The crowd is screaming and running for the exits. Then, on the small bounces up, the volume dries up. The selling is aggressive and committed, and the buying is weak and unenthusiastic. Anytime you see the price making a big move, your eyes should immediately dart down to the volume bars. Is the crowd roaring in agreement, or are they suspiciously silent? This simple check can save you from countless bad trades, especially from something traders call a fakeout. A fakeout is when the price breaks through a key level, tricking everyone into thinking a big move is starting, only for it to immediately reverse and trap them. It's a classic trap set by big players to prey on amateur excitement. But volume is the truth serum. Let's say a coin has been stuck at 50 cents for a week. It just can't seem to break above it. That 50-cent mark is a ceiling, a resistance level. Then suddenly the price shoots up to 51 cents. The amateur trader's brain screams, "This is it. It's breaking out. I have to get in now before it goes to $1." They jump in and buy. But the professional trader doesn't look at the price first. They look at the volume, and they see that on that supposed breakout to 51 cents, the volume bar is tiny. It's smaller than average. The crowd isn't roaring. It's whispering. This isn't a real breakout. This is a trap. And sure enough, moments later, the price collapses back down to 48 cents, stopping out all the amateurs who bought the fake move. Volume was the signal. Told you the move was a lie. But volume does more than just confirm trends. It can also signal the end of a trend. This is a more advanced concept, but it's incredibly powerful. It's called exhaustion volume or a climax top. Picture our rocket ship analogy from before. A trend is like a rocket firing its engines, pushing higher and higher. The volume is the amount of fuel being burned. In a healthy trend, the rocket burns fuel steadily. But what happens at the very end of its journey? Often, the last of the fuel ignites in one massive final burst of energy before it runs out completely. We see this in the market. A coin might be in an uptrend for days. Then one day it has a gigantic upward price move on the single biggest volume bar you've seen in months. The crowd is at a fever pitch. It's a deafening, euphoric roar. This looks incredibly bullish, right? But it's often the exact opposite. This is a climax. It represents the moment of maximum public participation. It's the point where every last person who was thinking about buying finally gives in to FOMO, the fear of missing out, and buys the coin all at once. It's the final desperate gasp of buying pressure. And once they've all bought, there's no one left to buy. The rocket has burned all its fuel. The buying is exhausted. And with no buyers left to push the price higher, the only way to go is down. These high-volume reversal points are some of the most profitable signals a day trader can find. The same thing happens at the bottom of a downtrend. After a long painful decline, you'll often see one final day of absolute panic. A massive price drop on cataclysmic volume. This is called a capitulation climax. It's the sound of every last holder finally giving up in disgust and selling their coins just to make the pain stop. And once they've all sold, there's no one left to sell. The selling pressure is exhausted. And with no sellers left to push the price lower, the only way to go is up. So you see, volume isn't just a simple little indicator at the bottom of your screen. It's the emotional heartbeat of the market. It's the one tool that lets you peer behind the curtain of price and see the real force of the buyers and sellers. It tells you if the big money is getting involved or sitting on the sidelines. It tells you if a move is the start of a new war or just a minor skirmish. When you see price rising but volume is falling, that's a warning sign. The market is like a general leading a charge up a hill, but when he looks back, he sees that his army of soldiers is getting smaller and smaller. That advance is not going to last. This is called divergence, and it's a red flag that the trend is running out of steam. Learning to read volume is like a doctor learning to listen to a patient's heartbeat. A strong, steady rhythm tells you things are healthy. A weak, thready pulse or a sudden frantic spike tells you there's a serious problem that the surface appearance might be hiding. Price is what you see. Volume is the truth. The price chart is the story, but the volume bars are the footnotes that tell you which parts of the story to believe. So we now understand that the market is a conversation, price is what's being said, and volume is how loudly it's being said. We can tell the difference between a confident shout and a hesitant whisper. But what if we could break it down even further? What if every single one of those price bars on the chart wasn't just a dot on a line, but a miniature story in itself? A story of a fierce moment-by-moment battle between buyers and sellers, a battle with a clear winner, a clear loser, and clues about who is likely to win the next battle. These aren't just lines or bars, they're called candlesticks. And learning to read their language is like learning to read the body language of the market itself. It's the final piece of the core puzzle, and it's exactly what we're going to decode next. Imagine you're at the world's most intense, high-stakes boxing match. But instead of two fighters in a ring, you have two armies. The buyers will call them the bulls and the sellers the bears. Every single second, they are locked in a brutal tug-of-war over price. The bulls are trying to push the price up, and the bears are trying to slam it down. A candlestick chart is simply the blow-by-blow, round-by-round account of this epic battle. Each and every candle tells the story of one round. So let's break down the anatomy of a single candle. It's made of two parts. The thick part, called the body, and the thin line sticking out of the top and bottom, called the wicks or the shadows. Think of the body as the main event of the round. It tells you two critical things. Where the price was when the starting bell rang, that's the open. And where the price was when the final bell rang, that's the close. The color of the body tells you who won the round. If the body is green, it means the price closed higher than it opened. The bulls won. They took control and pushed the price up. If the body is red, it means the price closed lower than it opened. The bears won that round. They dominated and dragged the price down. Simple, right? Green means up, red means down. Bulls versus bears. Now what about those thin lines, the wicks? The wicks tell you about the chaos that happened during the round. They show you the most extreme punches that were thrown. The very top of the upper wick shows the absolute highest price reached during that period. It's the moment the bulls were at their strongest, their ultimate high jab. And the very bottom of the lower wick shows the absolute lowest price. That was the bears' most powerful blow. The lowest they managed to push the price before the round ended. So a single candle gives you four pieces of information: the open, the close, the high, and the low. But more importantly, it tells you a story. Let's look at a few of these stories. Imagine you see a long, solid green candle with almost no wicks. What story is that telling you? It's a story of total domination. The bell rang, the bulls came out swinging, and they never let up. They pushed the price up, 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 and it closed right near the very peak of its strength. There was barely any fight from the bears. This is a knockout punch for the buyers. It signals incredible strength and upward momentum. Now flip that. You see a long, solid red candle. It's the exact opposite story. The bears were in complete control from start to finish. They slammed the price down and it closed at its absolute weakest point. This is a sign of immense selling pressure. It's the market screaming that sellers are in charge. But most fights aren't that one-sided. That's where the wicks become so important. Imagine a candle with a small body, but a very long upper wick. What does that story look like? It means the round started, and the bulls went on a massive offensive. They pushed the price way up. That's the long wick. It looked like they were going to win decisively. But then just before the bell, the bears staged a heroic comeback. They fought back with incredible force and pushed the price all the way back down so it closed near where it started. This candle tells a story of a failed rally. It's a warning sign. It shows the bulls tried to take new ground, but the bears were waiting for them and said, "Not so fast." And of course, there's the opposite. A small body with a long lower wick. This is a story of hope for the buyers. The bears took control early. They slammed the price way down, deep into new lows. It looked like a disaster, but then the bulls found their footing. They rallied, fought back, and pushed the price all the way back up to close near the opening price. This candle, often called a hammer, tells you that even though the bears showed their strength, the bulls refused to give up and are mounting a defense. It's often a sign that a downward trend might be running out of steam. Then you have the most fascinating candle of all, the doji. A doji is a candle with almost no body at all. It looks like a plus sign or a cross. The open price and the closed price are virtually the same. This is the story of a perfect stalemate, an absolute tie. The bulls and the bears fought each other to a standstill. The price might have swung wildly up and down, creating long wicks, but by the end of the round, neither side had gained an inch. A doji represents pure, unadulterated indecision. The market is pausing, holding its breath. It's a moment of quiet tension, often right before a massive, explosive move in one direction or the other. It's the market's way of saying, "I have no idea what to do next." And for a trader, that's a critical signal to pay very close attention. Now here's where it gets truly powerful. A single candle is like a single word. It gives you a hint, a piece of the story. But when you start putting them together, you get sentences. And those sentences form paragraphs, and the paragraphs tell the full story of the market. This is where candlestick patterns come in. Let me give you just one classic example. It's called a bullish engulfing pattern. Here's the story it tells. First, you see a red candle. The bears won the round. It might be a small victory, but they're in control, pushing the price down. But then the very next candle is a massive, powerful green candle. And this green candle is so big that its body completely engulfs the entire body of the previous red candle. It opens lower than the last candle closed, and closes higher than it opened. Think about the story here. The bears had momentum. They won the last round. Then the new round starts, and for a split second, it looks like the bears are still in control as the price opens lower. But then out of nowhere, the bulls unleash a tidal wave of buying pressure. They don't just erase the bears' gains from the last round. They completely overwhelm them, driving the price to a new high. This two-candle pattern is a story of a dramatic reversal. It's a powerful signal that the sentiment has shifted, the tide has turned, and the bulls are now firmly in command. It's crucial to remember that the round we've been talking about can be any time frame you choose. On a day trading chart, one candle might represent 1 minute of fighting, or 5 minutes, or 15. If you're looking at a 1-minute chart, you're watching a rapid-fire street brawl. If you're looking at a daily chart where each candle is one full day, you're watching a slow strategic war. The story is the same, but the timescale is different. Day traders live in the world of the shorter time frames, watching these 1-minute and 5-minute stories unfold, looking for those key patterns that signal an opportunity to strike. Learning to read these candles is like learning a new language. First, you just see shapes and colors, but soon you start to recognize words. Then you see sentences. And before you know it, you can read the epic story the market is telling you live as it happens. You're no longer just looking at a chart. You're interpreting the collective psychology, the fear and greed of millions of people, all distilled into these simple, beautiful little shapes. But what happens when you start combining these patterns? When you see a specific sequence of candles appear again and again, that's when you move from reading the market to predicting it. These recurring stories are called chart patterns, and they are the day trader's secret weapon for anticipating the next big move. These patterns aren't magic. They're not mystical signals from the crypto gods. They are pure, unadulterated human psychology, drawn on a chart for everyone to see. Think about it. Millions of people, all driven by the same two emotions, fear and greed, reacting to price changes. When they react in the same way over and over again, they create the same shapes. Learning to read these patterns is like learning to read the collective mind of the market. It's the closest thing we have to a crystal ball. So let's break down the most powerful, most common patterns you'll see every single day. They fall into two main camps: reversal patterns, which signal a trend is about to die and flip, and continuation patterns, which signal a trend is just taking a quick breather before roaring back to life. Let's start with the king of all reversal patterns, the head and shoulders. Imagine a market in a strong uptrend. Buyers are ecstatic, pushing the price higher and higher. They make a strong push up, creating a peak. That's the left shoulder. Then they pull back a little, take a breath. Feeling even more confident, they launch an even bigger, more powerful assault, pushing the price to a brand new high. This is the head. But at this new height, the momentum stalls. The push was exhausting. The price falls back down significantly, all the way back to where it was before that final push. Now the buyers are nervous. Their best shot didn't stick. They try one last time, a half-hearted push upwards, but it's weak. It doesn't even get close to the previous high. This feeble attempt forms the right shoulder. What is the story this pattern tells? It's a story of exhaustion. The bulls, the buyers, gave it 3 tries to break higher, and each attempt got weaker. The first push was strong, the second was the strongest, but the third was a failure. They're out of steam. The line that connects the low points between the shoulders and the head is called the neckline. And when the price breaks below that neckline, it's like a dam bursting. It's the market screaming that the buyers have officially lost control, and the bears, the sellers, are now in charge. The uptrend is over. And of course this works in reverse. An inverse head and shoulders looks like a clumsy drawing of a person hanging upside down. It forms at the bottom of a downtrend and signals that sellers are exhausted and buyers are about to take over. Same story, just flipped. Next up is another classic reversal pattern, the double top. It's simpler but just as deadly. The market is in an uptrend, it hits a high price, a point of resistance, and gets rejected. Pulls back. Buyers regroup and say, "All right, let's try that again with more power." They push the price right back up to that exact same high point, and it gets rejected again. Violently. Think about the psychology here. The market threw its best punch at a specific price level and it bounced off. It tried again and bounced off again. That price level is a brick wall. The buyer's confidence is shattered. A double top is a massive warning sign that the upward momentum is gone, and a reversal is highly likely. The opposite, a double bottom, which looks like the letter W, forms at the end of a downtrend and signals a potential surge upwards. 2 failed attempts to push the price lower means the sellers have lost their nerve. Now what about when the market isn't reversing but just pausing? That's where continuation patterns come in. The most common are flags and pennants. Imagine a stock or a coin has a massive explosive move upwards, a near vertical line on the chart. That's called the flagpole. This kind of move is unsustainable. The market needs to catch its breath. So for a few candles, the price will drift sideways or slightly downwards in a tight, narrow channel. This little channel looks like a flag hanging off the pole. This isn't a reversal. This is consolidation. It's the market digesting the huge move, shaking out the weak hands, and building up energy for the next leg up. Traders watch for the price to break out of the top of that flag pattern because it often signals the start of another explosive move upwards, usually of the same magnitude as the original flagpole. Pennants are almost identical to flags, but instead of forming a neat rectangular channel, the consolidation period forms a tiny, symmetrical triangle. The psychology is the same. A brief, quiet pause before the music starts again. This brings us to a bigger, more powerful category of patterns, triangles. There are 3 main types you need to know. First, the ascending triangle. This is a bullish pattern that shows a battle between increasingly aggressive buyers and stubborn sellers. You'll see the price making a series of higher lows. Each dip is not as low as the last one. The buyers are getting more and more impatient. But all of these higher lows are running into the same flat, horizontal ceiling of resistance. The sellers are holding firm at a specific price. What's the story? The buyers are coiling a spring. They are pushing and pushing, compressing the price against that flat ceiling. Eventually, something has to give. In an ascending triangle, the odds favor the buyers. When the price finally breaks out above that flat resistance, the move is often explosive. The opposite is the descending triangle. Here you have a flat horizontal floor of support and a series of lower highs. The sellers are getting more aggressive, pushing the price down, while the buyers are barely holding on at a specific support level. It's the mirror image story of mounting pressure, but this time it's bearish pressure. A break below that support floor is a major sell signal. So you can spot a pattern. Great. But that's only half the battle. Identifying a head and shoulders is useless if you don't know how to act on it. The most important rule is to wait for confirmation. A pattern is just a potential story until the final chapter is written. That final chapter is the breakout. For a head and shoulders, the confirmation is the price closing decisively below the neckline. For a triangle, it's the price closing outside the trend lines. Never, ever trade a pattern before it's complete. The market loves to paint a nearly perfect pattern, lure everyone in, and then rip in the opposite direction. Patience is your armor against these fakeouts. And here's a pro tip. Pay attention to volume. Volume is the fuel that makes moves legitimate. A breakout from a pattern on massive, surging volume is the market screaming its intention. It's a 5-star confirmation. A breakout on weak, pathetic volume is a whisper. Could easily be a trap. Always look for volume to confirm what the pattern is telling you. The beauty of these patterns is that they don't just tell you when to enter a trade. They often give you a roadmap for where the price might go. They provide a measured price target. For a triangle, you typically measure the height of the thickest part of the triangle and project that distance from the breakout point. For a head and shoulders, you measure the distance from the top of the head down to the neckline, and you project that distance down from where the price broke the neckline. It's an educated guess, a probability, not a guarantee. But in a world of chaos, having a data-driven target is an incredible advantage. By learning this language of patterns, you are no longer just staring at random squiggles on a screen. You are reading a story of human emotion. You can see the points of greed, the moments of fear, the battles between buyers and sellers, and most importantly, you can start to anticipate who is about to win. You're moving from a passive observer to an active participant who understands the narrative. But shapes on a chart are only one piece of the puzzle. They tell you about the structure of the market story. But how do you measure the momentum? How do you know if the buyers breaking out of a triangle are truly powerful, or if they're running on fumes? For that, we need to add another layer to our analysis. We need tools that act like a speedometer and a fuel gauge for the market. We need to talk about technical indicators. Think of technical indicators as the dashboard of your trading car. The chart patterns we just discussed, the triangles, the flags, the head and shoulders, they're like the map. They show you the road ahead, the potential turns, the possible destinations. But the map doesn't tell you how fast you're going, how much gas is in the tank, or if the engine is overheating. Indicators give you that crucial, real-time information. They live right on your chart and use mathematical formulas based on price and volume to give you an edge. Now, there are literally thousands of indicators out there. It's a jungle, and many new traders make the mistake of plastering their charts with so many flashing, squiggly lines that it looks like a Jackson Pollock painting. This is called analysis paralysis. We're not going to do that. We're going to focus on 3 of the most powerful, time-tested, and universally respected indicators. The Holy Trinity, if you will. Moving averages, the relative strength index, and volume. Let's start with moving averages. The name sounds boring, I know, but don't let it fool you. This is one of the most fundamental tools in a trader's arsenal. A moving average does exactly what it says. It calculates the average price of a crypto over a specific number of periods, say the last 20 days, and then it plots that average as a single smooth line on your chart. Why is this so powerful? Because crypto prices are noisy. They jump up and down every second, creating a jagged, chaotic line that can be hard to read. A moving average smooths out that noise like a suspension system on a bumpy road, letting you see the true underlying direction of the trend. It cuts through the chaos and reveals the clarity. There are 2 main types you'll hear about: the simple moving average, or SMA, and the exponential moving average, or EMA. The simple moving average is the most basic. To get the 20-day SMA, you just add up the closing prices for the last 20 days and divide by 20. Easy. The exponential moving average is a bit more sophisticated. It also averages prices, but it gives more weight to the most recent prices. Think of it this way: the EMA has a shorter memory. It reacts faster to new information. Many day traders prefer the EMA for exactly this reason, because in the fast-paced world of crypto, what happened 5 minutes ago is often more important than what happened 5 days ago. So how do we actually use them? The first and most obvious way is to identify the trend. If the price is consistently trading above a key moving average like the 50-day EMA, the trend is generally considered bullish or up. If the price is consistently trading below it, the trend is bearish or down. The angle of the moving average line itself is also a huge clue. Is it sloping upwards? That's bullish. Sloping downwards? Bearish. Trending sideways and flat? The market is consolidating, undecided. The second way we use them is as dynamic support and resistance. Remember our static, horizontal lines of support and resistance? Moving averages act like a moving, flowing river of support or resistance. In an uptrend, the price will often come down and bounce off a moving average before continuing higher, as if it's finding support on the current of the river. In a downtrend, it might rally up to a moving average, hit it like a ceiling, and then get rejected back down. But the real magic happens when you combine them. A very common strategy is to use a faster moving average and a slower one together. For example, the 20-period EMA and the 50-period EMA. When the faster 20 EMA crosses above the slower 50 EMA, it's a signal that momentum is shifting to the upside. This is called a golden cross. Conversely, when the fast 20 EMA crosses below the slow 50 EMA, it signals a potential shift to the downside. This is a death cross. These crosses aren't foolproof crystal balls, but they are powerful alerts that tell you the market's character might be changing. They're the flashing yellow light telling you to pay attention. Okay, so moving averages give us the general trend, the river's current. But what about the speed of that current? Is the trend strong and healthy? Or is it getting tired and ready to reverse? For that, we need our speedometer. We need the Relative Strength Index, or RSI. The RSI is what's known as a momentum oscillator. That's a fancy term, but all it does is measure the speed and change of price movements. It's displayed as a line graph that moves between two extremes, 0 and 100. The key levels to watch are 70 and 30. When the RSI goes above 70, it's generally considered overbought. Think of a rubber band being stretched too far to the upside. It doesn't mean the price will immediately crash, but it does suggest that the rally might be getting overheated and is due for a cool down or a pullback. When the RSI dips below 30, it's considered oversold. The rubber band has been stretched too far to the downside. The selling might be exhausted, and the price could be due for a bounce. Using overbought and oversold levels is the most basic way to use RSI, but its true power lies in a concept called divergence. This is one of the most important concepts you can learn in technical analysis, and it feels like a secret weapon once you understand it. Divergence is when the price and the indicator tell you two different stories. For example, let's say Bitcoin makes a new higher high. The price chart is clearly going up. You'd expect the RSI, our speedometer, to also make a new high, showing that momentum is strong. But what if it doesn't? What if the price makes a higher high but the RSI makes a lower high? This is called bearish divergence. It's a massive red flag. It's the market telling you, hey, even though we're pushing to new price highs, the energy, the conviction, the momentum behind this move is fading. It's like a car trying to go up a hill, but the engine is sputtering and losing power. It's often an early warning sign that the trend is about to reverse. The opposite is also true. If the price makes a new lower low but the RSI makes a higher low, that's bullish divergence. It's a sign that even though sellers are pushing the price down, the selling pressure is weakening. The downward momentum is running out of steam. It's often a signal that a bottom is forming and a reversal to the upside could be coming. Seeing divergence is like getting a sneak peek into the market's internal strength, something you'd never see by looking at price alone. So we have our map with chart patterns. We have our trend and dynamic support from moving averages. We have our speedometer and early warning system with the RSI. What's the final piece of the puzzle? What is the one thing that confirms everything? It's the fuel in the tank. It's volume. Volume simply represents the number of coins or contracts traded over a certain period. It's usually shown as vertical bars at the bottom of your chart. And it is, without a doubt, one of the most underrated and crucial indicators. Why? Because volume measures conviction. It measures participation. It separates the real moves from the fake ones. Think back to our breakout from a triangle pattern. If the price breaks out of that triangle on a massive spike in volume, what does that tell you? It tells you that a huge number of traders, the big money, the institutions, the herd, are all jumping in and agreeing with this new direction. There is immense energy and conviction behind that move. That is a high probability breakout. But what if the price meekly creeps out of the triangle on very low, pathetic-looking volume? That's a huge red flag. It suggests there's no real interest or power behind the move. It's like one person trying to start a standing ovation in a silent stadium. It's likely to fail. These low-volume breakouts are often fake-outs. Traps designed to lure in unsuspecting traders before the price whipsaws back in the other direction. Volume confirms trends. A healthy uptrend should see volume increase as the price rises and decrease as the price pulls back. This shows enthusiasm on the way up and a lack of interest in selling. Volume also signals exhaustion. If a price has been falling for a long time and then you suddenly see a massive climactic spike in volume, what's called a capitulation event, it can often signal that all the panic sellers have finally thrown in the towel, clearing the way for a bottom to form. Volume adds the crucial context of who and how many to the what and where of price action. It's the crowd's roar that confirms the touchdown. Putting these three together, moving averages for trend, RSI for momentum, and volume for conviction, creates a powerful multi-layered view of the market. You're no longer just guessing based on a simple line on a chart. You're now analyzing the market's direction, its speed, and its fuel level. You can see when a breakout from a pattern is backed by real power, or when a new high is actually a sign of weakness because of divergence. You're starting to read the story the chart is telling you. But having a toolbox full of amazing tools is one thing. Knowing how to combine them into a repeatable systematic plan is another. A hammer, a saw, and a measuring tape don't build a house by themselves. You need a blueprint. You need a strategy. So what does that blueprint, that strategy actually look like? It's not a feeling. It's not a hot tip you got from some guy on Twitter. A real trading strategy is a rigid, non-negotiable set of rules that you define before you ever risk a single dollar. Think of it like a pilot's pre-flight checklist. They don't just eyeball the wings and say, "Yeah, looks good." They follow a precise, repeatable procedure every single time to minimize the chance of catastrophic failure. Your trading strategy is your pre-flight checklist. Every robust strategy, no matter how simple or complex, must answer 4 critical questions. If you can't answer these 4 questions with 100% certainty before you click the buy button, you are not trading. You are gambling. First, what is my exact entry signal? What specific event or combination of events on the chart tells me now is the time to enter a trade? This can't be vague. It has to be binary. It either happened or it didn't. For example, I will enter a long position only when the 9-period moving average crosses above the 20-period moving average and the RSI is below 70. See how specific that is. There's no room for interpretation. Second, what is my profit target? Where will I get out of the trade to lock in my winnings? Are you aiming for a fixed 2% gain? Are you selling when the price hits a known resistance level? Are you using a trailing stop loss that follows the price up and sells when it reverses? You need to know your exit plan for a winning trade before you even get in. Hope is not a strategy. Third, and this is the most important one, what is my stop loss? This is your eject button, your fire escape. This is the predetermined price at which you admit you were wrong, you take a small manageable loss, and you live to trade another day. Forgetting this is like flying a plane without a parachute. Sooner or later you're going to crash and it will be fatal to your account. Your stop loss is your non-negotiable line in the sand. And fourth, what is my position size? How much of my capital am I putting on the line for this one trade? A common rule for beginners is the 1% rule. This means you set your stop loss and position size so that if the trade goes against you and hits that stop loss, you only lose 1% of your total trading capital. If you have a $10,000 account, you risk $100. This single rule prevents you from blowing up your account on 1 or 2 bad trades. And trust me, you will have bad trades. So, with that framework in mind, let's look at some of the most common day trading blueprints that people use. First up is scalping. If trend trading is like surfing a big wave, scalping is like being a hummingbird. You're not trying to catch a huge move. You're darting in and out of the market all day long, taking tiny sips of profit from very small price fluctuations. A scalper might make dozens or even hundreds of trades in a single day, aiming to make just a tiny fraction of a percent on each one. Their goal is to let these tiny wins compound into a significant profit by the end of the day. A scalping strategy might use a very short-term chart, like the 1-minute or 5-minute chart. The entry signal could be something as simple as a moving average crossover, or the price touching the lower Bollinger Band. Because the profit targets are so small, the stop losses have to be incredibly tight as well. This is a high-frequency, high-intensity style of trading. It requires immense focus and discipline. The big danger for scalpers? Transaction fees. If your profits on each trade are tiny, the fees for buying and selling can easily eat up all your gains and then some. It's a game of speed, precision, and volume. Next, we have momentum trading, which is also often called trend following. This is the opposite of scalping. Here you are that surfer. Your job isn't to predict when a trend will start. Your job is to identify an existing, strong trend and ride it for as long as you can. You're looking for a coin that is clearly, decisively moving in one direction on high volume. The old saying is, the trend is your friend, and momentum traders live by that creed. A momentum trader's entry signal might be a breakout. This is when a price smashes through a previously established level of resistance. Imagine a ceiling that the price has hit 3 or 4 times and bounced off. When it finally breaks through that ceiling with a lot of power, a lot of volume, that's a signal to a momentum trader that a new strong upward trend might be starting. They jump in, placing their stop loss just below that old ceiling, which has now become a new floor of support. Their profit target? It might not be a fixed price. They might simply ride the trend, using a trailing stop loss that moves up as the price moves up, only getting out when the trend finally shows clear signs of reversing. They're trying to catch the big explosive moves. Then there's range trading. If momentum trading is about riding a wave, range trading is like playing tennis. You're not looking for a breakout. You're looking for a market that's bouncing back and forth between 2 clear levels, a floor of support and a ceiling of resistance. The market is stuck in a range. A range trader's strategy is beautifully simple. They buy at the floor and sell at the ceiling. Buy at support, sell at resistance. They use tools like Bollinger Bands or identify horizontal support and resistance lines. When the price hits the bottom of the range, that's their entry signal to buy. Their stop loss goes just below that support level in case the floor breaks. Their profit target is the top of the range, that ceiling of resistance. It's a strategy that thrives in calm, sideways markets where there isn't a strong trend in either direction. The danger, of course, is that the range will eventually break. If you buy at the bottom of the range and the price smashes through the floor instead of bouncing back up, you have to honor your stop loss immediately, because that range-bound market may have just turned into a powerful downward trend. Scalping, momentum, and range trading are just 3 examples. There are hundreds of variations and combinations. Some traders focus on specific chart patterns like flags or head and shoulders. Others build complex strategies combining multiple indicators. But here's the secret. The perfect strategy doesn't exist. The best strategy is the one that fits your personality, your risk tolerance, and your schedule. A high-stress scalping strategy that requires you to be glued to the screen for 8 hours a day might be a nightmare for you, but a perfect fit for someone else. The most important step, after you've built your blueprint with its 4 key questions answered, is to test it. You do not test a new strategy with real money. That's financial suicide. You backtest it. You become a market historian. You go back in time on the charts, weeks, months, even years, and you apply your rules. You meticulously record every single time your entry signal appeared. You log the result. Was it a win? Was it a loss? How big? After analyzing hundreds of historical trades, you'll have data. You'll know your strategy's historical win rate, its average win versus its average loss. This tells you if your strategy even has a statistical edge. If it looks good on paper, you move to the next step, paper trading. You trade the live market in real time but with fake money. This tests your ability to execute the strategy under real market conditions without risking your capital. Only after a strategy has been proven profitable in backtesting and paper trading should you even consider trading it with a small amount of real money. You have to prove the blueprint is sound before you start building the house. Because once real money is on the line, a new, powerful, and often destructive element enters the equation: your own emotions. And mastering your own psychology is the final and hardest piece of the puzzle. Because let's be brutally honest, you can have the world's best strategy, the fastest internet connection, and charts that look like a NASA mission control screen. But if you can't control the volatile mess of chemicals firing between your own ears, you will lose. Full stop. Your biggest enemy in the market isn't a whale dumping their bags. It isn't a sudden news event. It's the person staring back at you in the mirror when the pressure is on. This entire game, once you strip away the jargon and the technicals, is played on a psychological battlefield. And there are 2 titans, 2 ancient generals who have been wiping out traders for centuries: fear and greed. They are the twin wrecking balls of your trading account. Let's start with fear. Fear wears many masks, but its most common and seductive disguise in crypto is FOMO, the fear of missing out. You see it happen. A coin you were watching but didn't buy suddenly has a green candle that looks like a skyscraper. It's up 15% in an hour. Twitter is exploding. Everyone is posting rocket ship emojis. And a voice in your head starts screaming. It's not a whisper. It's a primal, gut-wrenching scream that says, "You're missing it. This is the one. Everyone else is getting rich, and you're sitting here like an idiot. Get in now before it goes to the moon." So you do. You abandon your plan. You forget all your rules about entry points and risk management. You market buy at the absolute peak, right as the early smart money traders are starting to sell their positions to people just like you. And for a moment, it might even go up a tiny bit more. You feel a rush of genius. Then the reversal happens. That skyscraper of a green candle is met with a red one that looks like an elevator with a snapped cable. In minutes, you're down 10%. Your stomach drops. This is the FOMO trap. It's a psychological ambush designed to prey on your insecurity and your desire for easy money. Acting on FOMO is like showing up to a party right as the police are arriving. You missed all the fun and you're guaranteed to be part of the disaster. The other side of fear is even more insidious. It's the fear of taking a loss. Let's say you make a trade, you follow your plan, but the market just turns against you. It happens. Your technical analysis told you it should go up, but it goes down. Your stop loss is set at a 2% loss. The price gets closer and closer to that stop loss. And that same voice starts talking again, but this time it's pleading. Don't sell. It'll come back. If you sell now, the loss becomes real. Just give it a little more room. It's just a dip. So you move your stop loss down. You give it more room. It keeps dropping. Now you're down 5%. The panic starts to set in, but your ego is now involved. Admitting you were wrong now would hurt more than it did at 2%. So you hold. You HODL. You tell yourself you're a long-term investor now. You've just turned a small, disciplined, manageable day trading loss into a crippling long-term investment in a coin you probably don't even believe in. This is how traders blow up their accounts. Not in one big catastrophic event, but through a series of small, undisciplined decisions fueled by the fear of being wrong. A stop loss isn't an admission of failure. It's a business expense. It's an insurance policy against your own ego. Honoring it is the single most important act of a disciplined trader. Now let's talk about fear's destructive twin, greed. If fear makes you take bad trades or hold losers too long, greed makes you sabotage your winners. Convinces you that you're a genius. Imagine you're on a winning streak. You've nailed 3 trades in a row. The money is flowing in. You feel invincible. You feel like you've cracked the code. Greed whispers in your ear. You've got the hot hand. Don't stop now. The market is your personal ATM. Take another trade. A bigger one this time. This is called overtrading. You start seeing patterns that aren't there. You bend your rules because, hey, you're on a roll. You increase your position size, taking on way more risk than your plan allows. This is the gambler's high. And just like in a casino, the house always has the edge. Your winning streak was a result of following your plan. Your inevitable crushing loss will be the result of abandoning it, because greed told you you were special. Greed also ruins perfectly good trades. You're in a winning position. Your plan says to take profit when the coin hits a certain price. Let's say a 5% gain. The price hits your target. Your plan, which you created when you were calm and rational, is screaming sell. Execute the plan. But greed whispers something else. Look at that momentum. This thing isn't stopping. 5% is for amateurs. Let's hold for 10%. Maybe 20%. Don't leave all that money on the table. So you ignore your take profit level. You hold on. The price inches a little higher and your heart pounds. But then the momentum stalls. A big seller steps in. The price tumbles, blowing past your original 5% target. Now you're only up 2%. Panic mixes with anger. I'm not selling for a measly 2% when I was just up 5%. So you hold, hoping it bounces back. Doesn't. It drops back to your entry price, and now your winning trade is worthless. Sometimes it even goes negative. You just let greed turn a successful, planned trade into a break-even or a loss. The goal is not to catch the absolute top of every move. The goal is to consistently execute profitable trades according to your plan. So how do you fight these monsters? You can't kill them. Fear and greed are part of being human, but you can build a cage for them. That cage is your trading plan, and the bars are made of discipline. First, you must treat this as a business, not a hobby or a trip to Vegas. A business has a business plan. It tracks expenses. It analyzes performance. It has rules. You need to do the same. This means keeping a detailed trading journal. Every single trade. What was your reason for entry? What was your exit plan? What was your position size? And most importantly, how did you feel? Were you scared? Were you greedy? Were you bored and just wanted some action? Writing it down forces you to confront your emotional state. Your journal will become the most valuable book you ever own. It is the unvarnished truth of your performance, and it will show you in black and white that every time you broke your rules, you lost money. Second, you must become a robot. I don't mean you should become unfeeling. I mean you must become the dispassionate executor of a system. Your job during market hours is not to think, not to feel, not to predict. Your job is to execute the plan that your smart, rational, calm self already created when the markets were closed. That's it. If your rules say buy, you buy. If they say sell, you sell. If they say sit on your hands and do nothing, you go for a walk. You are an employee and the trading plan is your boss. A very strict boss. Finally, you have to shift your focus from outcomes to process. This is the ultimate mental leap. A new trader judges their day by whether they made or lost money. A professional trader judges their day by how well they followed their plan. You can do everything right, perfect analysis, perfect entry, perfect discipline, and still lose a trade. That's just probability. That was a good day. You followed the process. Conversely, you can do everything wrong, chase a FOMO pump with no plan, and get lucky with a win. That was a terrible day. Why? Because it reinforced a catastrophic habit that will eventually wipe you out. Your goal is not to be right on every trade. Your goal is to have a robust process that gives you an edge over the long run, and to have the ironclad discipline to execute that process flawlessly, over and over and over again, regardless of the outcome of any single trade. When you can take a loss without flinching because you know it was a good trade according to your system, and take a win without feeling like a genius because you know you were just executing the plan, that is the moment you transform from a gambler into a trader. That is the moment you begin to conquer the battlefield in your mind. And once you understand that the war is internal, the path to victory becomes clear. It's not about finding a magic indicator or a secret signal group. It's about forging an ironclad process and having the discipline to follow it, day in and day out, when you're winning and, more importantly, when you're losing. So how do you do it? How do you take all the theory, all the concepts we've covered, and turn them into a real tangible skill? This is the part of the journey where 90% of people get it wrong. They hear everything we've talked about, they get excited, they feel inspired, and they immediately run off and deposit $1,000 into an exchange, ready to become a millionaire by Friday. And almost without exception, they lose it all. They skip the most crucial phase of development. They try to fly a fighter jet without ever touching a flight simulator. So I'm going to give you the blueprint, the path that the successful minority follows. It's not sexy. It's not fast, but it is the only path that works. Your journey begins with one single non-negotiable step: paper trading. I know I can already hear the groans. It's fake money, it's not the same, there's no emotion. And that is precisely the point. Your goal in the paper trading phase is not to make $1 billion fake dollars. Your goal is to prove, in a zero-risk environment, that you can follow your system. That's it. You are not testing your ability to get rich. You are testing your ability to be disciplined. You will pick one strategy, just one. Maybe it's a moving average crossover on the 15-minute chart. Maybe it's a support and resistance bounce strategy. It doesn't need to be complicated. It needs to be concrete, with clear entry, exit, and stop-loss rules. Then, for the next 60 to 90 days, your only job is to show up and execute that strategy. You will take every single setup that your rules dictate. You will not take any trades that fall outside your rules. You will keep a detailed journal of every trade. The setup, the entry, the exit, the profit or loss, and most importantly, a note on how well you followed your plan. Were you tempted to move your stop-loss? Did you exit too early out of fear? Be brutally honest with yourself. This is your dojo. This is where you build the foundation. If you can't follow the rules with fake money, you have absolutely zero chance of following them when real money and real fear are coursing through your veins. You must be consistently profitable on paper for at least 2 consecutive months before you even think about moving to the next stage. If you can't do that, you are not ready. Period. Once you've proven your system and your discipline in the simulator, you graduate to stage 2 microstakes. You will open a real account and fund it with an amount of money that is frankly insignificant to you. $50, $100. An amount that, if you lost it all tomorrow, it would not affect your life in any meaningful way. It's your tuition fee. Now the game changes. That $10 trade will make your heart pound more than a $10,000 paper trade ever did. This is where you meet the real dragon, your own psychology. The goal here is not to make money. The goal is to get used to the feeling of having real skin in the game while still executing your plan flawlessly. You are conditioning yourself. You are training your nervous system to remain calm under pressure. You will use the exact same strategy you perfected in paper trading, But you will now do it with the added weight of real-world consequences. Your position sizes will be tiny. You might be making or losing $1 per trade. That's perfect. You are not here to pay your rent. You are here to earn your stripes. You must prove you can be profitable even on this tiny scale for another 60 to 90 days. Only then, after you have proven consistency in the simulator and consistency with microstakes, do you earn the right to move to stage 3 scaling. This is where you slowly, methodically, and incrementally increase your position size. You don't jump from risking $1 per trade to risking 100. You increase it by 25% or 50%. You trade at that new level until it feels completely normal, until the emotional charge is gone. Then you increase it again. Your account size and your risk size grow in lockstep with your skill and your psychological fortitude. This is how a professional business scales. It's a process of gradual earned growth. It's not a lottery ticket. This 3-stage process, simulator, microstakes, scaling, is the path. It is the filter that separates the 90% who fail from the 10% who succeed. People fail because they are impatient. They are driven by greed. They want the reward without the work. They want the crown without the battle. They see trading as a shortcut to wealth, when in reality, it is one of the most demanding personal development journeys you could ever embark upon. Think of a master surgeon. She didn't just read a book and then start performing heart surgery. She spent years in medical school, years in residency. She practiced on dummies, then assisted senior surgeons, then performed minor procedures under supervision, slowly earning the right to take on more and more responsibility. When she walks into that operating room, she is calm. She is focused. She has a precise plan. She follows a checklist. If a complication arises, she doesn't panic and start guessing. She reverts to her training, identifies the problem, and executes a pre-planned protocol to solve it. Her movements are deliberate, efficient, and devoid of ego. She is a master of her craft because she has put in the thousands of hours of disciplined practice required to become one. That is the mindset of a trader. You are the surgeon. The market is your patient. Your trading plan is your surgical procedure. Your risk management is your sterile field, protecting you from catastrophic infection. Every trade is a procedure. You perform it according to your training, you log the results, and you move on to the next one. Some will be successful. Some will be losses. But you, the professional, are emotionally detached from the outcome of any single procedure. Your confidence comes not from a single win, but from your trust in your overall process, a process you have tested and refined over hundreds, if not thousands of repetitions. So, as we come to the end of this journey together, I want you to understand something. This wasn't just about explaining what crypto day trading is. It was about giving you the map. The real map. The one that shows the long, winding, and often difficult road through the mountains. Not the fake one that promises a shortcut straight through them. That shortcut leads off a cliff. The real path, the one that requires patience, discipline, and a deep commitment to self-mastery. That is the path that leads to the summit. Your journey starts now. But it doesn't start by funding an exchange account. It starts with a decision to respect the process, a decision to become a student of the market and, more importantly, a student of yourself. So here is my challenge to you. For the next 30 days, do not trade a single dollar of real money. Open a paper trading account. Find a simple rule-based strategy, and just practice. Execute. Log your trades. Study your mistakes. Learn to follow a plan without deviation. That's it. Start the process of forging the discipline that will one day be the foundation of your success. Down in the comments, I want you to write day 1. That's it. Just day 1. It's a public declaration to yourself and to this community that you are starting your journey the right way. You are choosing the path of the surgeon, not the gambler. Because in the end, crypto day trading is not a get-rich-quick scheme. It is a craft. It's a high-performance skill. And the ultimate prize isn't just the money that comes with it. The ultimate prize is the person you must become to achieve it. Disciplined, patient, resilient, and in complete control of your own mind. That is the real treasure. And your journey to find it starts today.